Ashish Gupta is now with us. He's a market master of the day, Chief Investment Officer at Axis AMC. Ashish, good morning. Good to have you with us here. Thanks very much. So I have to ask you, markets we'll get to, but the budgets, this session, we've got about 2 sessions out, right? I mean, just thematically, if you were to think about it, 2 questions actually. Will it be a good budget? When I say good, good for the market, obviously. And second, in what way will it be good?
So, hi, Prashant. Prashant, I think the good news is that we are going into the budget this time around with fairly muted expectations. So, I think that's a positive going into the budget. Frankly, we have already seen a lot of positive steps taken by the government outside the budget in the last 6-9 months. Right, so we have had indirect tax cuts, we had labor code, we had additional announcements on production incentives recently in the trade deal. So it is not really so much that can be done in the budget at this point of time. I think the more important indicator will be on the path to fiscal consolidation and policy stability. We have seen really a sell-off in the bond market over the last 6 months, despite very aggressive monetary action. And I think some comfort is needed by the markets on that front. So I think if the paths of fiscal consolidation can be reiterated, there is more confidence that comes to the market in terms of the supply of bonds that will come to the market. That will be a big positive. There are expectations built around if they are going to be tinkering around the capital gains tax, etc. Frankly, we don't have too much expectations there. And as I mentioned, stability in taxation policy is equally important. I think one area where there can be potentially some positive coming through is if we do something on the withholding tax. Capital outflows have been a big pain point over the last 12 months. And I think if withholding tax regime can be revisited, that should actually help at least debt capital flows into the market. So I think that would be one area I would look at.
Just one thing, Ashish, you said, stocks typically like more deficit spending. You're saying that it'll be nice if fiscal deficit is contracted, all right? I mean, expectation is it'll be 4.4 and then 4.3, 4.2, the budgeted number. So you're saying that's what markets, stock markets would like? Bond markets, of course, is another story, but what's your sense?
Well, I think the equity markets will also like that. I think what we need is really lower cost of capital. Given the kind of pressure the currency has been and the forex intervention that has been undertaken, if you see today, interest rates are actually higher than where they were in September, right? So the 10-year bond yield is up about 20-25 basis points compared to September, since when RBI has cut rate by about 75 basis points. In the last 2 months or so, even the short-term rates have hardened by about 40-50 basis points. So I think we need really more comfort to come in the bond market and money market for the equity markets, because the equity market respond to growth, right? And you need better financial conditions, stronger credit growth to be supported. And if we have a challenge on credit demand being met, that will clearly not be positive for the equity markets.
Ashish, hi, morning. The expectation was that earnings recovery will take place. FY27 is going to be much better in terms of earnings growth, maybe a mid-teens kind of a growth. After last year's underperformance, which was the worst seen in 2 decades, even the valuation premium of India has narrowed considerably. Yet Indian markets continue to struggle and underperform global markets. So what explains that, and what is your view on equities now?
So I think clearly on both these fronts, you are right that earnings growth is looking much better. Even if we look at the earnings that have come through for this quarter, they have been reasonably good, not just in the large cap, even mid and small cap earnings have come in fairly decent. We are looking at 20% plus growth for most of the mid and small caps that have reported so far. I think the challenge has been, or where the expectations have proven to be wrong, is how strong the global growth is. And last year, actually, global growth has held up very, very well. Global growth is likely to be nearly 3.5% for 2025. And the earnings recovery in other markets has been much stronger. In fact, if I look at 2026 earnings for the broader emerging markets, that is now expected to be nearly 22%. Even in the US, so if you recall, in the US till last year, really earnings growth was only a Mag 7 story, but now that earnings recovery has become much more broad-based. So even companies outside the Mag 7, you are actually looking at mid-teen earnings growth in the US. And US GDP till now has belied all expectations. Despite all the tariffs, immigration policy, etc. If you recall, last quarter, US real GDP growth was about 4%. In fact, US nominal GDP growth last quarter at 8% was very similar to India's nominal GDP growth. And in fact, this quarter, US real GDP growth is likely to be even higher than the last quarter. So in this scenario, actually, we have not seen capital flows coming to India. So while India's growth has recovered and earnings is looking better, the recovery and earnings growth in the global market has actually been even stronger.
Okay. Hi, Ashish. Good morning. Nigel on this side, and good to see you. And as always, well, 2025 was the year of the global AI trade, and India missed out there. Now, the hope was that slows down. It's not really showing signs as of now. How important do you think that this AI trade is, and it's slowing down globally? That maybe in turn could attract some capital back into India. Your take?
Yeah. So I think that's certainly true. I think, but as I mentioned till now, what we are seeing in the US for now, the growth is actually broad-basing. And it's not only just the AI. So if you look at the US small cap index, both in terms of earnings as well as price momentum, that's actually now starting to do well. And over the last 3 months, it's actually outperforming the Mag 7. In fact, 5 of the Mag 7 stocks actually underperformed the broader US market last year. So I think we are not yet seeing a slowdown. You would have seen the Fed commentary as well yesterday that the concerns on the job market in the US have also moderated. So US growth continues to be driven not just by AI spending, but really retail spending is very robust. US manufacturing and capex is also strong. And that's why we have not really seen kind of capital flows towards India reversing, and that continues to weigh on the market.
Ashish, in terms of sectors that you like, I believe the consumption theme is something that you like. Drill it down a little bit. You like autos as well. What would qualify as the consumption basket that you like?
Yes. So we do like autos, and in autos, clearly post the GST cut, we have seen continued momentum now, even in the two-wheeler and the entry-level car segment. We are actually seeing demand and the cycle broad-basing now. Even the commercial vehicle cycle is looking up. So even the CV cycle uptrend is visible. Over the last couple of months, cement demand has picked up. Actually, if you look at the macro indicators in India, as expected, over the last couple of months, they have shown steady improvement. And you look at electricity demand, you look at cement consumption, you look at e-way bills. So growth in all those pockets have picked up. And therefore, I don't think there is a concern that we are going to see disappointment in earnings growth in India. I think the challenge for the market is really that capital flows have not turned. And we saw almost $19 billion of FII outflow last year and almost $3 billion this month. So I think that is the big challenge. I think while all the talk is around the tariffs, but the current account is still not in a very bad shape. So the current account deficit is still likely to be around 1.5% of GDP only. But it's really the turn in capital account that we need for really the currency and the markets to recover.
Okay, you briefly mentioned cement, so I'm just going to take that point a little forward because, I've been listening into some con calls and I'm looking at the results as well. Q3 was on expected lines weak. But if you're looking at a domestic play and where there is traction on ground, and as you said, December was strong and January has been fairly good. Will cement be something that you'll be looking at? Domestic play on the economy as well? And we're seeing traction both on pricing as well as on volumes.
Yes, so I think certainly, and it's a sector that has not really performed last year. We are also seeing one very strong structural theme of consolidation in that sector. So I think cement is clearly ticking the boxes on multiple counts.
All right. We leave the conversation here. Ashish, thank you very much for joining in and explaining so beautifully what is really the problem when it comes to India and why India is not recovering or seeing a pickup despite that expected earnings growth.